Guys, thank you so much for jumping on today. Tax strategy, specifically entrepreneurs, things you guys need to know in 2025. We got a lot of good meat on the bone for you guys today. And I see Jeff, I see you there, brother. I see you on the elliptical every morning. We got some people I recognize. So this is good. But I'm excited. I wanted to get together with somebody that holds respect in my life. And so I'm excited to bring Brett on with you guys and partner with him and his firm to bring some expertise towards you guys and just bring something good. So thank you guys for joining. We're going to admit people as they keep coming on board here, but we're going to go ahead and get launching. I'm going to share my screen and get moving. I'm going to move down the agenda for you guys. And what we'll do is we're going to jump in some introductions. Want you guys to know who the heck we are, our firms, what we do, who we speak to, and a little bit about us and our families. And then we'll jump into those key strategies. We'll go through a Q&A at the end, and then we'll conclude with any sort of call to action that you guys want to jump on. But we want to provide a bunch of value. I'll tell you what we're going to do with this recording. We're recording right now. We'll have a transcript. If you want that, you can message us that you want it. We're also going to be putting this out there on our social channels and cutting it up a little bit because I know we're going to get some good pieces of information here. And so I encourage you guys to go follow Brett, Shifflett Philips, right, his firm and his social channels, and go follow Pro Capital and our social channels. We both have podcasts, which is really cool. We're just BSing about it, about him drinking bourbon and having a good time with his buddy. And so in the meantime, we'll get going. You guys get to stare at a couple bald headeds. We both are like twins right now because we got the sweaters and the button ups going on. But let's do this. We'll jump into introductions. I'll kick us off. My name is Cory Procter. I own Pro Capital Wealth Management, a financial firm here in Southlake, Texas, where we do financial planning with an emphasis in asset protection. It's based off my story. I was sued. I got into a car accident in high school as a junior. Of all good boy things to be doing, I was going to a church function in the summer at the lake and rear-ended this lady. And she didn't like it. And she ended up filing suit. And a year later, my mom and stepdad filed for bankruptcy and had to start over. And so that was a big thing to me because I ended up playing 6 years in the NFL, mostly with the Dallas Cowboys. And I didn't want that ending my way. So I just did whatever I could to learn about my money and my investments and what I was getting involved with. And I'll tell you, 15 years removed from the NFL, my wife and I, Megan, who's the most beautiful thing in the world, but will stab you in the neck if you get out of line. We're a lot more powerful place financially today than we've ever been playing football. And so, my hope for everybody around us, and especially you guys as entrepreneurs, you guys are taking risks in your business, is that you end up in that same place. And so that became the mantra of Pro Capital, was standing guard, building legacy, making sure the castle couldn't get stolen from underneath you. And we work specifically mostly with entrepreneurs, growth-based people. We have a minimum $1 million investable assets. But for those people that are go-getters, they're go-givers, they're go-getters, they want to go attack, but we want to make sure that we can manage assets, do the financial planning, manage the risk side of the balance sheet, everything that's accounted for, and make sure that you have a bed that's made that you can go attack it and you don't have to worry about those things. And an example of that is we have a large client that was really great, and we found $1.5 million off the books. Their tax attorney and their CPA of over 40 years didn't know was there. We'll look at assets like real estate. If it's titled in your personal name, it's a lawsuit issue. And all of a sudden, a conversation the other day, we had 2 rental properties, single home rental properties. And okay, how's that title? What's in my name? Well, did you have a plan for that? What's your plan when somebody wants to sue and have a party at that place and they break the leg? And they're like, well, what do you mean? I go, well, kiss those 2 rental properties goodbye and kiss the $8 million in the brokerage account goodbye, because it's all leaving if that's the case. And so that's an example of something that we go look for because of my history. And basically, like most people in our business, starting in with the money, which is an important thing, investing, retirement planning, asset allocation are all great, but it means nothing if it can get stolen. And so that's where we look at first, is where could the thief come in? And so that's a very powerful place. And it's been a great testimony for us to launch from. And it's basically we can replicate what we've done in my life. So I'm married. My wife is amazing. Told you her. We have 3 kids. 10-year-old Grace. I lift weights with her on purpose so she can rip the throat out of some dude that wants to rub up on her. Okay. We have a 5-year-old boy, Hank, who's destroying my house. And we have a 1-year-old girl tomorrow, Faith, is the most beautiful ham you've ever met in your life. And so we love it here. Our kids go to school, Liberty and Argyle. We live in Trophy Club business, Southway. But we're happy to be here. I got Shaler is one of our advisors. You see his name on the screen, Shaler Smith, one of our guys here. Go to the website, procapitaltx.com, if you want to do some more research, but it's great. But right now, I want to hand it off to Brett so he can give a little piece about him.
Yeah, hey guys, thanks for joining us today, and thanks Cory for putting this together. This is great. I always love to talk taxes and go over some of the key strategies to help people minimize their overall tax liability. Um, as Cory said, my name is Brett Phillips. I'm the founding partner of Shifflett Philips CPA Firm here in Frisco, Texas. We specialize in small to medium sized businesses, so from startup to 50 million, $100 million in revenue. We work with a lot of professional services, so a lot of doctors, lawyers, high net worth individuals, investors, a lot of real estate professionals, and really go over kind of 3 main strategies. So we start with structuring, making sure that they're set up properly to help minimize their overall tax liability. Then we look at tax deductions, make sure that we're maximizing tax deductions. And then we look at available tax credits, making sure that we're taking all those available tax credits that are out there. And they're really industry specific. You know, Congress really creates these credits and deductions to help incentivize people to do what they want them to do. So they want you to create jobs. They want you to invest in infrastructure, in real estate. And we need to take full advantage of those to help minimize your overall tax liability. I was going to play in the NFL, but I hurt my knee. So unlike Cory, I unfortunately didn't get to play in the NFL, but I was close. I was right there.
Hey, you're handsome enough,
Um,
though. You can do it. We're like brothers right now.
that's right. But yeah, we work with high net worth individuals. We work with business owners, and yeah, we have a lot of overlapping in the type of clients that we work with. So Cory's been a great resource and trusted advisor, and we always appreciate whenever we can jump on and chat taxes. So yeah, I'm ready to jump into it. You ready, Cory?
Heck yeah. What you guys don't know is I harass Brett on the regular. And so he gets tired of hearing from me because when I got a question, I'm like a bulldog and I go after it really, really fast. So I really appreciate him coming on. So he's got to hear my voice way too much. Okay, well, let's jump into it. And what we're going to do here is largely Brett is going to be the major share on here, and I'll jump in and add because we do a lot of tax planning and strategic planning for our people because and I don't know where you guys are at with your people, but what we see that comes in is a lot of CPAs are just filers and they're looking backwards. They don't ever look ahead. And so we want to be able to blast a ton of taxes out of your guys' life, not just today, but in the future. And so you see through some strategic planning, like just how we can do that. So we'll jump into it right away. Here are some key strategies for you guys specifically as entrepreneurs. Take it away, Brett.
Great. So the first thing we always look at, like I said, the first kind of key point that we look at when we're dealing with a new client is to make sure that they're structured properly. And there's quite a few options out there. So you can set up, an LLC, S corp, limited partnership, C corporation, LLP. And there's all kinds of different options. And they're all taxed slightly differently. And today we're talking about entrepreneurship and business owners who typically have some kind of operating company, whether they're financial advisors, attorneys, doctors, any type of professional service or even product type businesses. Um, so most people will go ahead whenever they're going to start a business. They say, let's set up an LLC and get this thing rolling. Everybody hears of LLCs. It's the simplest type of entity formation. It gives you legal liability protection, but it's not the most tax efficient vehicle. So it's not going to provide you with really any tax benefits. Um, From a federal tax perspective, an LLC is going to be a disregarded entity. It's going to, if you own 100% of it, it's going to file combined with your personal tax return. If you have a business partner, it will file as a partnership tax return. But it's great for just starting off. So if you're thinking of, hey, I want to start a new business, great, let's form an LLC and get it started. But once you start generating revenue and some profitability, then it makes sense to start to look at different options. So any profitable operating company should probably be structured as an S corporation for the main purpose of saving on self-employment taxes. So with an LLC, your net income is all subject to self-employment tax, which is Social Security and Medicare. It's 7.65% for the employee, 7.65% for the employer. So as a self-employed individual, you're paying both sides. You're paying 15.3% self-employment tax on the net income of the business. So in order to minimize that, you can elect to be treated as an S corporation, and then it kind of breaks your income into two different buckets. So you have your earnings, which are paid through W-2 wages. You become an employee of the business. Those earnings are subject to self-employment tax, but any distributions that you take out are not subject to that additional tax. So if your business nets, let's say $100,000 of net profit after all of your expenses, you can pay yourself a wage of, say, $30,000. That $30,000 wage is subject to that 15.3% tax, but the 70,000 that you take out is not subject to that additional tax. So that would save you, in that example, around $10,000 of self-employment tax. Um, so that's a huge, first structure for any operating companies to make sure that you're set up properly. And there's other entity formations. There's limited partnerships. Those are mainly used for like real estate. If you're putting together a group of investors who want to buy an office building, you have a general partner, limited partners. The limited partners are have limited liability. The general partner has all the liability in that partnership. Um, those are great for structuring real estate. Um, Another one that's commonly overlooked because of the double taxation is C corporations. Now, C corporations are great because of a code section called 1202, which is qualified small business stock. And what this allows you to do is to, if you have original issued shares, you hold those shares for 5 years, you sell those shares in a stock deal, you can exclude $10 million of capital gains on the sale of those shares. So this is great for technology companies, software development companies, things that don't have a lot of upfront costs. So if you don't have to buy, a lot of supplies and materials, and you're not going to be running, big losses, big capital losses up front. We had a company. It was a gaming company. They were creating mobile apps, mobile games. It's about 10 guys that were original issued shareholders. They grew this thing. They sold it, made a ton of money, sold it for well over $100 million, and they excluded almost all of the gain from tax. I mean, could you imagine that you get this windfall of money, and you're thinking, oh, I'm going to pay 20% capital gains tax on all this money, but that you know this structure allowed them to exclude the entire amount um, from capital gains. So it could be a huge tax savings. And we have some clients that are developing businesses, and they created, when they originally founded the business, they structured it as a C corporation with this code section in mind, thinking, this is going to either be a home run or it's going to be a nothing. So I'm going to create this, set it up as a C corporation, knowing that I have 5 year runway to get this thing up and profitable and sellable. Um, and then hopefully, they're in year 3 or 4, so hopefully they make it and create something that can be sold and exclude all the capital gains on that sale. So that's a huge advantage. We see that more and more and being brought up more, and they keep lowering the corporate tax rate as well. It's now 21%, but I think Trump has made comments that he wants to lower that even further. So yes, structuring the business entity up front is huge and can be a major tax savings. And you have options. So even if you think, well, maybe I'm not structured quite as tax efficiently as possible, like let's set up a meeting and go over your structure. And like I said, that's always kind of the first thing we look at when we onboard a new client is to make sure that they're structured properly and as tax efficient as possible.
I don't
Have
know
you,
about you guys, but this is a big one for me, right? First time Brett and I met. I don't know if you guys have ever been with a very conservative CPA. I like guys that are aggressive a little bit. So he had me in the first meeting when we restructured my business to maximize our take home. And this was a big deal because we've just implemented that into the firm as common practice. And so this is a big deal. Go ahead, Brett.
Yeah, so that's huge. I mean, that could save you a ton of money, especially if you have an profitable operating company and you're like, this is gonna be my business. I'm gonna run this for years. If you can save it's not just a 1 year $10,000 savings. This is the compounding over however long you're operating the business. So, you compound that out and put that money aside, and you're ready to retire in no time. All right, let's move on. So that's the business structure. That one's huge. Next one's going to be depreciation. So there's two methods to depreciation expense. Two methods of accelerated depreciation expense, I should say. There's bonus depreciation, and then there's Section 179. And a lot of people get these two confused or use them overlapping, but they are somewhat separate. So bonus depreciation allows you to take accelerated depreciation on assets that you buy. So think of business equipment, machinery, furniture, computers, software. You can take all those expenses up front versus having to take them over 5, 7, 15 years. So you can upfront that cost and take it in year one and get a big pop. They're slowly scaling back bonus depreciation. So during COVID, it was 100%, and it's dropped 20% a year. This year it's 40% for 2025. Next year it'll be 20%, and then it'll be eliminated. Although Congress has made indications that they would like to extend bonus depreciation to 100% for an extended period of time, but as of now, it's 40% for 2025. Last year was 60%. So if you bought any fixed assets last year, we'll be able to take 60%. Or we can take Section 179 and take 100%. But the big benefit of bonus depreciation is you can take it negative. So if your P&L is right at break even, you can take bonus depreciation negative, which you can't do with Section 179. Section 179, you can be a profitable business and you can take that down to zero, but you can't take it below zero. So that's one of the biggest benefits of bonus depreciation is that if you're buying a bunch of capital assets, especially in the first few years of you're starting a business, you can take that below zero and maximize those expenses. Another thing on depreciation is vehicles. So if you have a vehicle that's over 6,000 gross vehicular pounds, it would qualify for bonus depreciation or Section 179. So you can get that big pop in a year. You always hear people trying to look at their P&Ls right before year end and think, oh, I need to go buy a new truck or a new van or something for the business, and then we can write that all off at year end. That's always a big tax plan. Clients love that too. Like, hey guy, you need to go buy you a new truck before year end. And they're like, all right, yeah, I love this. I love my CPA. He's telling me I need to go buy a Raptor or something cool before
Well,
year end.
expand on that if you don't mind. And I'll tell you, like we've gone through this before, guys. We bought last 2 years, we bought vehicles, and this year we're looking at a building. And where we've had a conversation with a guy the other day. He actually delayed payments, asked some of his clients, he's in the construction business, delay payments to January because he planned on buying a building in the next year, in this year. I mean, as you're looking at any of those depreciating assets that you can use to offset any sort of income, I mean, is there a general rule of thumb of like, hey, when do I buy this out? Should I space it out or should I lump them all in 1 year? Or what does that typically look like when you're getting those questions?
Yeah, that's a great question. I always look at time value of money. I want to pay the least amount of tax possible in the current year. Um, but with that being said, sometimes, if you know your income is going to increase or you know you have bonuses coming up, you may want to spread that out or opt out of bonus depreciation and allow that asset to run 5 years, 7 years, to offset future years. Or if you think, hey, the tax rates are going to go up. If the new president was to come into office and you think, well, their policies are going to have to be to raise taxes. Let's think about pushing that depreciation expense out to future years. That'll have a bigger impact. And we can run all of these scenarios out and show you. Okay, if we take all the bonus depreciation up front, this is what it looks like, or if we extend it out, um, this is the deduction that you would get annually over the next 5 years or 7 years. Um, when you're talking about real estate, there's a lot that you can do there as well. So there's something called a cost segregation study that allows you to accelerate depreciation on a building. So if you were to go in and an older building or build a brand new building, whenever you place it in service, you can do a cost segregation study where they'll have an engineer go in and look at the building, and they'll allocate the different components of the building to different buckets. And they'll say, carpeting and flooring, drywall, electrical, plumbing, bathroom appliances, um, kitchen, appliances and cabinets. And they'll break it all down into components. And then you can take accelerated depreciation on all those smaller components that qualify as 5 year, 7 year, 15-year assets versus having to take it. Residential is 27 and a half years, commercial real estate is 39 years. So, it could be a really long life asset. And you can push some of that depreciation up front and take it quickly, and that allows you to run big deductions. This is also great for high income earning W-2 employees. You could buy a short-term rental if it qualifies as it's less than 7 days. The average rental is less than 7 days. You can take a cost segregation study, really maximize that depreciation, boost it up, and it can offset some of your W-2 income. There are certain qualifications you have to jump through to make sure that you would qualify for that. But that's one of the biggest benefits, especially when with high income earning W-2 employees. You just kind of capped at the things that you can do. So short-term rentals has been a huge tax savings for those employees, especially if you can harness that with maybe a spouse or someone else who can qualify as a real estate professional and allow you to take those losses against that income. It can be huge tax savings. Um, my wife is now a real estate agent, which which helps to take some of that accelerated depreciation against my income, because she's an active real estate professional.
Heck yeah, that's great. And I'll tell you, in our business, a lot, right, in the wealth management business, a lot of people are about AUM all day long, and so we charge a separate consulting fee other than any of that. But because of that, so many of our business, they're afraid of that asset leaving under their management and buying a property or something. When I'll tell you, like me personally, my family has been a huge beneficiary of real estate and using that depreciation. So we actively look for those opportunities. So I love hearing these things, especially as business owners, because I'm a big advocate of, if you own your business, if you're running your business, you should own the building you operate out of, or at least make it a goal to do that. And so I've even had mentors in my business that was one thing they regretted. And they were like, don't, and they got big checks after writing or selling their business down the line and did phenomenal. But that was one thing that, man, I could have bought my building and had this asset that was building along the way and used the depreciation. And they're like, I don't know why I ever did that. So I want to plant that seed for anybody who's not there, to encourage you to make that a goal. Thanks, Brett. That's great.
Yeah, yeah, that's our goal as well. we're in this big office building that we don't own, but yeah, our lease is up in 2027, so we're looking at maybe building something or buying something. But yeah, you know, I hate writing that rent check every month, thinking, geez, I could be saving a portion of this down on a mortgage. One
Good,
other thing
good for a season.
on yeah. On Section 179, that does allow you to offset. There are some caps on that. So if you place a large amount of assets in service in 1 year, um, it starts to phase out around $3 million. It doesn't impact most businesses, but if you're putting a large amount of equipment in place in 1 year, you need to make sure that you don't get caught on that phase out. Um, yeah, depreciation is a big one, and it literally gives you that flexibility. It's real. It's always a big part of our year-end tax planning whenever we're meeting with clients towards year end and thinking, geez, man, these guys are really profitable this year. What options do we have? And this is normally the biggest one. Like, let's look at, you need to refresh any equipment, you need to buy new automobiles. Let's go ahead and place those in service and get that deduction up front. Um, One other thing on automobiles, there's also recapture. So if you do take bonus depreciation, you want to make sure you're keeping that automobile for a long period of time. You don't want to be, flipping automobiles every couple of years because you're gonna get hit with that recapture on the sale of that automobile.
Nobody wants to hear that. Just let me do it every year, man.
Yeah, well,
I'm gonna
you can
do-
always buy more cars. You just can't sell them. If you sell them, it's a problem.
I want to encourage you guys to hear also, as a part of our asset protection, as a big emphasis in our firm, is we look for like where the devil could come in, right? And this is my story. So I told you about the car wreck that I got into, and it ended up reaching my mom and my stepdad's personal assets. Luckily, it didn't touch the business. There are stories where it has. But in this situation, if you have, you can deduct the your vehicles, which is really great. But you also, I'm going to give you a free piece of advice right now: is add your business as an insurer or insured driver on your insurance. Okay, because if it doesn't, you're just a personal. A lot of people will get the personal for the rates because you get a better rate technically instead of doing a commercial title over the top of that thing to get commercial insurance because it's more expensive there. But I get it, and the person will get the rates, but you also want to add your business as an insured driver on there so that when you're writing those things off, you get that reach for the insurance instead of them rejecting you should somebody come attack you as you're driving on the job. And so that's a really big one right there that we look for is like, hey, how can you get screwed? And so that's a simple thing you can do. So you're welcome for that free piece of advice.
Yeah, it's surprising. Insurance is such an important part of the business and making sure that you're properly insured, especially with rental properties and things that you're not overseeing as much, and you're kind of trusting other people to be on your property and dealing with your stuff. I mean, there's some people out there that will just see you over nothing, and you have to protect yourself and you have to defend yourself against those frivolous litigations. So, um, yeah, that's insurance, and even having umbrella policies, to kind of cover everything is important as well.
That's right. Awesome. Are you good there? Next slide.
Yep,
The
we're
man.
ready. Let's
Come
keep
on,
it
baby.
rolling. All right, this is a great one. This is one of my favorite tools to use is putting your kids to work in your business. So you can pay your children up to the standard deduction of a single individual. So for 2024, it was 14,600. For 2025, it's $15,000. You can pay them. You get the tax deduction at your business level, and they don't have to report or pay taxes on the income. So there's no Social Security, there's no Medicare, there's no federal income tax. As long as their total income is below that standard deduction, they're not required to file and pay taxes on this income. The business gets the tax deduction. It's one of those rare occurrences where somebody else doesn't have to pick up the income and you get to take the tax deduction on the business. We have another one coming up here in a second that we'll talk about. but paying your kids is one of the best because you get to teach them work ethic. You get to teach, you get to have your family around. I mean, that's one of the coolest things about starting a business is that you get to pick the people that you get to work with. Um, so working with families is amazing. It teaches them work ethic. It teaches them all these things, um, and you get a little tax deduction, a little tax benefit from it. A couple tricks to this is you can't pay them through an S corporation or a C corporation, so it needs to be an LLC or a partnership. Um, you can always create a separate LLC that's paid by your S corporation um, to pay for children, and it needs to have a business purpose, but it could be like a cleaning service that you provide or outside services that you provide, and you can pay your children through that entity. It doesn't even have to be an entity; it could just be a sole proprietorship. Um, but a few technical issues. You do need to issue them a W-2 at the end of the year. You need to keep payroll records. You don't just want to cut them a check for the full $15,000 on December 31st and take a big tax deduction. You want to treat them like a normal employee. So you want to be tracking their hours. You want to be tracking the tasks that they perform. Pay them just like any other employee, whether it be biweekly or once a month. Write them a check or do direct deposit. And make sure that you're treating them like a normal employee. And one of the benefits, one of the biggest benefits, is now they have earned income. Now they can set up a Roth IRA and start contributing to a Roth IRA, um, which is huge. You could have a kid from the age 5 to 17, and they're working in your business and they're contributing. What's the Roth this year? 7,000, 8,000.
7,000 right now.
Yeah.
Yeah.
So, they'll have, 10, 12 years that they're contributing. They'll have 100 grand in a Roth IRA by the time, they head off to college. So, it could be a huge tax saving vehicle, and huge tax savings for you as well as the business owner.
This is a great one that I love sharing. If anybody's getting our newsletter and saw the blurb that we had put in our newsletter about writing off your kids' private tuition, this is basically a loop around that. So a lot of us our kids go to Liberty, and I mean, you're talking about 30 grand a year for two kids plus going in private tuition. You're like, and us as business owners, come on, I know you guys think about this like I do, is you're like, how can I do that? I called Brett when I had to pay for a funeral one time. I'm like, can I write this off as an event? Are you going to let me do this? And he was like, Brett, he just laughed just like that. and, and,
The
and
casket has Pro Capital inside of it.
but but we all think because it's a big bill, we want to write off those big bills. Well, what's one way I can do it? If I have two kids at private, I got 15 grand each at standard deduction that I can pay these kids out and essentially pay them. They can create a bank account for them specifically that pays their tuition. So great tool there. But I love the custodial Roth accounts where I can put 7 grand or max out a Roth account or whatever I can a year for my kids, because the time they hit 60, I got tax-free growth in that money. They're going to have way more than any of their teachers will. And this is a really cool, easy trick to do that not frankly nobody who's ever come in our office is playing for. So this is you would think a lot of people are put together, but a lot of people are successful, not put together. And this is really where we're able to maximize some dollars for people, is executing strategies like this.
Yeah, and you hear this all the time, in the news where they're saying, "Why don't we set up plans for like newborn babies where we put $10,000 into an account for this kid and then let it grow, and this could pay for their college education you know, or whatever." But yeah, this is kind of the same thing. You're creating that kind of kickstart for your children and getting a big tax deduction for it as well.
Love it.
Yeah, so I love that. Pay your kids, put them to work. What was your first job, Cory?
I was a paper boy. I had a paper route, and they gave me a whistle to defend myself from any dogs that might be attacking. Okay, so that was my first first job, and I split the cash with my older brother Clay, and it was kind of crazy. But I mean, other than my actual pay where I got a W-2 was I worked at a Texaco gas station, and I used to have to dress up as the slushy dog in the summer and wave at people on the street, and that was in high school. So
You got a picture of that?
I hope so. I need to go find it if I do. But I used to go sit in the freezer to cool off. Big boy
That's
sweats,
great.
man.
That's great. All right, you ready for the next one?
Next slide.
This one's got Cory written all over it.
Does it?
So this is the retirement plans for your small business. So um, there's a lot of options when it comes to retirement plans, and we see people hesitant to want to tie up cash, especially entrepreneurs who are like, "Hey, I don't want to put my money in a retirement plan and then have it, not be able to use it in the market, and not be able to access it for things that I need in the business." But you get a huge tax deduction. It's great for employees if you have employees for employee retention. You can put vesting schedules on a 401k. So employees are considering leaving. You're like, hey, you're leaving all this money on the table too. Um, so it's a great way for employee retention. Plus, employees like it. They need to retire. They want to save for retirement as well. So if you're a single owner business, there's a solo 401k. If you don't have any employees, that one's great. You can contribute. The employee can contribute up to 23,000, and then the employer can match 25% of your compensation up to a total of $69,000. There's a huge cap on what you can contribute to a solo 401k. If you're a profitable solo business, that's the route I would go. I would probably stay away from a SEP because SEPs are good. They're easy. They're simple to set up, and they're simple to understand. But they're capped at 25% of your SE income. So the solo 401k kind of gets around that. Yeah, single or very few employees or no employees, I would go with the solo 401k. Correct me if you have a different opinion on that, Cory. This is kind of your area of expertise.
No, oh,
Um,
I tell you what, I love deferral vehicles are really good. And so I always use myself as an example or as a guinea pig for anybody to example or to base off of is my life. I've had a lot of great and a lot of bad. I've done a lot of good things, I've done a lot of stupid things, right? But um one thing that I did is, I maxed out as much as I could in my player 401k when I'm playing ball. And then I got different benefits after I was playing ball. When they told you they don't need you anymore, that's fun to hear. But I got different benefits afterwards that I deferred it all over to my IRA and then ultimately over to my company 401k. And and so the reason I share that is I've seen massive growth in my accounts and through different ways. But that tax deferral, that vehicle, a lot of what we do is we're looking at vehicles in which people are placing their money. It's not just asset allocation, it's what are we utilizing that's available to us. And so I always talk about the tax code is a coupon book. You can choose to use a coupon book, or leave it at home and pay max price, max retail. So we can try to use the coupon book and try to snip and save and keep more money in the pocket away from Uncle Sam, or you're fine paying retail. God bless you. But I give you one thing that was really cool. This is a difference of a deferral account versus just a taxable account investment, a traditional investment account. Is if I was in the market, if I put $1 million in a traditional taxable account in 2006, all the way up to 2019, all right, and I had basically an 8.5%, or excuse me, I just put it in the market. That million turned into 16 million in that time frame in a regular taxable account. So 16x during that time. That's a lot. I want that performance. I love that. That's great. Okay. But if it was in a deferred account, that million turned to 28 million instead of 16. So you had a $12 million delta there. That's a big deal, right? And so now, obviously, if I can get into a tax-free bucket like a Roth account, I'm going to do that all day. But that tax deferral is a very powerful thing. Why? Is because anytime I trade or I'm doing anything in that account, I'm not subject to any tax also. And so I can let it cook for a long time. And then I'll tell you what, these solo Ks, what we'll do a lot, nobody ever does backdoor Roths. Nobody. And in our
Mm.
business, they're like, you make too much money. I'm like, have you ever heard of a backdoor? And they'll be like, well, it's not that much money to put away. And they don't want to mess with it because it's not $1 million. But I don't know about you guys. My kids are pretty important to me because if I can get some asset protection, I can get some income tax free money, growth out of my investments. I'm going to do that. And then if I die, I want that to go to my family income tax free if I can. And so it all goes to them. And so a lot of times um, I'm gonna pay tax on my seed instead of my harvest. But ultimately that tax deferral whether it's pre-tax or post-tax, is a super powerful vehicle that a lot of my um, deferral vehicles have grown in a lot of the same investments exponentially faster than my taxable accounts have. And so it ends up being crazy story. And if you hear about the last administration wanted to get rid of the mega IRA accounts. Well, this is an instance where like we had a client that wanted to put into a whiskey company, and he wanted to put I think it was like 20 or 30 grand into this thing. And I go, well, hey, let's look at a Roth conversion for you. And because he had some Roth money, but not a ton, he didn't want to move that. Let's look at some Roth conversions. And then we'll look at putting that 20 grand into a self-directed Roth account. And then you can put that money into the whiskey company because they planned on selling it in 10 years. This guy was about 50 years old. I go, when they're 60, if this thing pops like you want it to do, 60 years old, that thing pops and you got 10 million or you got all that, however much was made off of that, that's a big deal. And
Right.
if you hear the stories, I can't remember who it was. It was like one of the founders of executives of one of the like PayPal's or one of the payment companies. They did 5 grand in company stock in a self-directed Roth, blew up to like 700 million, like something stupid. And now you have to keep it 5 years and keep it till you're 59 and a half there. Those are the rules. But man, I don't know. Like, and I'm not going to speak to anybody's opinion, but I'll pay some penalty taxes. If I got 700 million, I'm going to take 10 of that, pay some penalty tax. I'm going to say, babe, let's go to the beach. And I can reallocate that somewhere else if I want. So, I say that I get passionate because these are some really cool things that you can do that we have blown taxes out of the water for people's financial plan. That has eclipsed any fee that they ever paid towards us. This is why I'm quick to pay Brett and his firm to handle my stuff. This is why I know people, they come into ours and they're like, man, that was a big bill. And they're like, okay, well, first move off the gate, we saved you 27 grand this year in one move. And they're like, what? And I go, so if you like that, you're really going to love the rest of this. So this is instances like this that really get you excited, especially as a business owner, because you're paying a crazy amount of taxes.
Right. Absolutely. So, there's a couple other options. If you have employees as well, we're still talking about retirement plans here. There's simple IRAs, and then there's traditional 401ks that most people are aware of. A simple IRA, it's good to start with, especially if you have just a few employees. Each employee has their own account. You're funding those accounts every year, and they're still an employer match, but the employees control the account. There's no vesting schedule. They receive the funds immediately, and it's their money. It's in their account. Um, but they're easy to set up. They're super inexpensive to operate, and it's just an easy way to start. So when we first started hiring people, we set up a simple IRA, ran that for a few years, and then as we continued to hire people, and we had enough employees, it made sense to roll over to a 401k. We switched over to a traditional 401k, and now we have vesting schedules where people have to work for a certain number of years to get that employer match, which is great. So I would say if you have under 10 employees, I would look at a simple IRA. If you have more than 10 employees, probably go ahead and doing that traditional 401k makes the most sense.
Awesome. Next
And
slide. Oh,
there's tax credits as well, up to $5,000 for the first 3 years to cover any professional fees related to setting up that retirement account. So they're really wanting employers to set up these accounts and fund their employees' retirements. Yep.
yeah,
Yes.
this is a good
All
one.
right.
I like this one.
This is a good one. I love this one. The Augusta rule. So the Augusta rule, if you got any golf fans out there, is based on the Masters golf tournament in Augusta, Georgia. The citizens that live in Augusta, live around the golf course, they get, it's a huge golf tournament. It's out in the middle of nowhere. They have all these people come into town for a week. They rent everything. They, eat out at all the restaurants, but they rent all the houses. They kind of take over the town for a week, and then they disappear. And, these people that live there in this town, everyone rents out their house for the week or the 10 days or whatever, and then that's like the only time people come in town and rent anything. So they lobbied their congressman and said, hey, we don't want to have to pay income tax for these days when people come in. We're not like full-time renters. We just rent our house for 10 days while people come in for the golf tournament. Then when they leave, we move back in, and that's the only time we rent our house out is during the Masters week. So Congress said, okay, great. That makes sense. So if you rent your house for less than 14 days a year, you don't have to pay any income tax on that income. It's tax free. We'll give you this. You guys are nice people for renting your house out to these goofy golfers. Um, so savvy business owners said, well, I own a house and I own a business, which is separate from my personal business, my personal activity. So can't my business rent my house for me for up to 14 days? I don't have to report that income on my personal tax return. My business gets to take that tax deduction on the business return. So this is a great strategy. It's gone through the courts. Everyone agrees that it works. There's no question about it. So the homeowners can rent their house to their business. It has to be less than 14 days. You want to document how you came up with the fair market value. So go on, Airbnb or call up the hotel nearby and say, what do you guys charge for a conference room for the day? And you can have your board meetings, your strategy sessions, your team retreats. You can do all those at your house, rent your home to your business, take the deduction on your business tax return, and not have to report the income on your personal return. So this is another one of those kind of weird situations where you get the tax deduction on one hand and you don't have to report the income on the other hand. So we love this situation. You're creating this tax deduction, you're not having to recognize the income, or nobody has to recognize the income. So the keys to this is make sure you're documenting the days, the business purpose, how you came up with the fair market value, um, and make sure it has actual substance to it. It's not just you know hey, tonight we're having a business meeting, honey, and and we're gonna write this up as a $1,000 tax deduction. It needs to have some kind of substance to it.
I
Um,
think Four
the-
Seasons is not the Motel 6.
yeah, yeah, I'd probably call the most expensive hotel in town. Hey, my house is nice, so I'm gonna rent it out. I better get paid
Exactly.
for it.
High end, baby.
Uh,
Listen, they did
yeah,
$6 a
but
night.
But think about that. If it's $1,500 a day, let's say it's 14 days, that's a $21,000 tax deduction you get on your business, and you don't have to report that on your personal. So you just came up with $21,000 tax deduction. That's huge. Yeah, document it, have a good fair market value, and it cannot exceed 14 days. The Augusta rule. We love it.
Good one. Next slide.
Yeah. Yep.
All right.
So this is for S corporation owners. This is called an accountable plan. So this is how you reimburse. This is how you get that home office deduction. This is how you get your mileage expense reimbursed, your cell phone, your internet, your home internet. This is how you get your personal meals or travel expense that you're not putting through the business. This is how you get all that reimbursed to you. You get that tax deduction on the business, and you get that reimbursed expense paid to you. You don't have to recognize the income. The business gets the tax deduction. So, as an LLC or something like that, you would normally just report these expenses on your personal tax return for like the home office calculation and things like that. But you can't, since you're an employee of the S corporation, you can't take that home office deduction on your personal tax return. So we reimburse you through the business, and we document that through an accountable plan. So we calculate what the deduction would be. We write it up in this plan and say, hey, we're going to reimburse ourselves $500 a month for home office, for cell phone, internet, you know, and we just write it up in that plan. We take the deduction, and again, we don't have to recognize that income on our personal tax return. That makes
Awesome.
sense.
That's good. We got to speed it up just a little bit. Make sure we stay on our hour mark.
Okay. Yep. I think we're on the
Is
last
that
one.
cool?
Yep.
Come on. There we go.
Estimated tax payments. So with all this, you have your business, you have your investment income that's killing it, you have all this extra income. If you're going to owe more than $1,000 at the end of the year, the IRS wants you to make quarterly estimated tax payments. So these are due April 15th, June 15th, September 15th, and then January 15th of the following year. Um, and there's two safe harbor methods to calculate these estimated tax payments. So if you make over $150,000 a year, which I assume most of you do, it is 110% of your prior year tax liability. So you take your prior year tax liability, divide that, or multiply that times 110%, divide that by 4. That's what you need to have paid in each quarter to be safe harbor to avoid any penalties and interest in the following year. The other method is if your income fluctuates a bit. This is really good for like realtors or people that have income that goes way up, way down. It's kind of all over the place. The other safe harbor method is 90% of your current year tax liability. So for this, we would calculate what your current tax liability. We'd take your income for that quarter, calculate what your tax liability is for that quarter, and then pay that in each quarter. So some quarters you may pay in 20 grand, some quarters you may pay nothing. So depending on the income that was made in that quarter, we pay that in. So those are the two safe harbor methods, and they avoid any penalties and interest. But if you just keep in mind, if you owe more than $1,000 in tax at the end of the year, not including like withholdings on your W-2, but additional tax, then the IRS would like to see you make quarterly estimated tax payments. And you can always adjust your withholdings as well. If you're a W-2 employee, you can always just bump up your withholdings so you avoid having to make those quarterly estimated tax payments. That's it.
That's awesome.
That's all of them.
Well, let's do this. We got just a couple minutes. What I want to do is, if you have any questions, we take a couple questions, and then we'll wrap up to honor your time. But does anybody have any questions before we go? Throw them in the chat. I know we had one. I wanted to make sure. Oh, Heather, I needed this information 5 years ago when I bought my business, had a kid in private school. Johanna, we pay our 8-year-old to spray paint the curbside numbers on our rental properties. Does that count? I would say so.
Yeah, that counts. Yeah. I'd pay him. I mean, you probably can't pay him $15,000 to do that, but you could pay him something.
That's a heck of a marketing fee.
Yeah,
I could do that.
Yeah, a lot of people do that with like, they'll put their family in their marketing. They'll say, what does it cost to hire a model to come in and pretend to be my family? Oh, they charge $1,000 a day or whatever. Okay, great. I'm going to pay my family, my children, $1,000 a day to be, to do these marketing shoots and to be in all of our ads and stuff like that.
It's expensive.
It may not be $1,000 a day. It may not be $1,000 a day. I'm making that up.
Hey, same thing. Four Seasons, man. My baby's expensive. They're beautiful. Okay. A lot to put those faces on our marketing. That's awesome. Well, if you have any more questions, put them at the bottom here. What I want to do this is I super appreciate you guys showing up. There's basically 2 calls to action. If you guys are interested in talking, would love to talk. And if we can't work together, we'll point you in the right direction. Also, where I was going, I was going to go on I was going to share my other screen here, but I want you guys to see. I love two things for us is shoot us an email, and I'll show you that screen here in a little bit. And Brett, if you don't mind, put your information in here. Somebody was asking for our emails earlier on, and um, Joanna, hopefully have a lot of questions. Or I have a lot of questions for you. Hopefully we can connect this week. Awesome. Love that. But I also like to encourage people to go to our site. And so if you see here, this is our Pro Capital website. Top, if you're interested in talking, you can schedule a goals call. It's a 15-minute discovery call. You're a fit if, some testimonials, why us. And then down at the bottom is if you want to join our newsletter. We got a bunch of people that are on here, entrepreneurs, leaders. They get this every other week right now, and we might even start weekly. We'll see. We get some good traction on that stuff. But I want to encourage you guys to sign up for that if you haven't already. And we release a lot of great information there. So do that, and then I'll come back and share Brett's. Here we go. Our last side here, as I'm just showing things around. But our email. So if you guys want to shoot a message to us and answer any other questions that were past this, we're free to set that time up, and it'll be really good. But we love jumping into this stuff. Brett has been a great resource for me because I told you before, I'm a bulldog. I want the meat on the bone, and I'm going to go scrap everything that I can to make sure we maximize our business, maximize our family, because we're going for broke, man. We're going for big in our life, and I want you guys to do the same and win that same way in your business. So this has been really awesome, and Brett, I'm super thankful for you joining me and getting on this thing.
Absolutely. That was fun, Cory. I appreciate you setting this up. And yeah, if anybody wants to reach out, I'm always happy to chat taxes. And yeah, we work with all kinds of business owners. We have people that do social media, and we have people that are executives at Fortune 500 companies. We work with a lot of different range of clients, and a lot of different business owners. And each the topics that we went over today kind of apply to most businesses, but each industry's a little bit unique, and there's tax deductions and things that we can do to help maximize expenses within specific industries as well. We do some logistic companies, and there's certain rules for you know trips that are in Texas versus trips that go across, state lines are treated differently. There's all kinds of weird little rules for each industry. So, we work with all kinds of businesses, and we'd be happy to take a look at your situation and see if we'd be a good fit.
Heck yeah. Well, hey, thanks, guys. If you like this, share it, reach out, but share it with your friends. And our big thing is spreading the word. So we love doing what we do, and we know you guys do too. So, hey, thanks so much. You guys have a great rest of your Wednesday. It is 12:59 on the dot, so you're welcome for a minute early, and we will see you guys later. All right.
Thanks, guys.
Thanks, guys.